Assalamu alaikum. Let's start today's class of Principles of Accounting. Today we'll be discussing the chapter 6 inventories, the basics, and probably we'll do some maths in the next class or probably in this class too. Just the basics in today's class. We'll be discussing advanced topics in the next session, inshallah. What will we be learning in this chapter has been summarized in the contents section for you. First of all, we'll learn about the classification of inventories. How do merchandising companies and manufacturing companies classify their inventories? There's some differences. We'll be learning that, and how do they account for their inventories? We'll be learning that too. Moving on, we'll be determining the inventories, the amounts. We will check the physical amounts and the financial amounts too. Are they similar or not? We'll be discussing that in this section. And we'll discuss the inventory costing methods such as FIFO, first in first out method. We'll also be discussing about LIFO. Some people calls that LIFO. I call that LIFO. That means last in first out. We'll be discussing that also. And the final inventory costing method we'll be discussing about is the average costing method. We'll be discussing two types of method. One is periodic and the other one is perpetual. There are some differences when we use the methods in different situation. We'll be learning that, inshallah. Then finally, how the inventories are presented in the financial statements and how do we can analyze those numbers. We'll learn that too. And finally, we'll have a mini quiz session of 5 or 4 quizzes to check your basic concepts about the chapter at the very ending. So we are studying the first section, a section where we classify the inventories as merchandising or manufacturing. Moving on to the classifying inventories. We are talking about the merchandising inventory and manufacturing inventories. Both have different kinds of method to record their inventories. First of all, merchandising companies own the products, what they sell and what they buy. Those are ready-made products. They don't usually create any or add any values to the products they buy, and thus they make those classification as only inventories. And we are saying that inventories are owned by the company and they're ready for sale, and they term those products as inventories only, nothing more, nothing less. If you give example, as the picture shows, a grocery store is an example of merchandising company. If we talk about in our Bangladeshi perspective, we can say examples of Agora, Shopno, Mina Bazaar, Miniso. They are merchandising companies. They buy ready-made products from their suppliers or vendors or importers, and they sell those products as it is. They make no changes or they add no values within the product. So what they buy, they just sell them, and they term those products or stocks as inventories only. So moving on to the manufacturing companies, they term their products as or inventories in 3 steps. Those are raw materials, work in progress, and finished goods. What manufacturers do, they buy raw materials from their suppliers or vendors. They buy raw materials. If we talk about a mobile, when a mobile company, for example Xiaomi, Apple or Samsung, they buy motherboards from different companies. They buy chips, processors, RAMs, storages from different companies. and those are raw materials for the company. And if we give example of automobile industry, they buy engines from different companies, they buy leathers from different companies, they buy transmissions, they buy different types of products which they use in their final product. So when they buy those things, they buy them as raw materials, not inventories. They buy them as raw materials which will they assemble or make their own product by the use of those raw materials. So we are talking about the basic goods that will be used in the production. The first step or the first stage of a production is collecting the raw materials. So after collecting raw materials, they will process or they will assemble those raw materials in their working progress. If we talk about the mobile companies, they bought mobile chips, motherboards, RAMs, storages from different companies, and they will assemble in their assembly line or in their company or in their factory. They will assemble those different things in a mobile phone or a mobile case. And we are talking about that as work in progress. When they started there working on their raw materials, assembling those raw materials, we say the products are in work in progress, which means the raw materials are placed in the production but not completed yet. So if we talk about the raw materials of the automobile companies, we said that they have collected engines, they have collected transmissions, seats, leathers, and different types of instruments from different sources. Now they have started building their car in the car structure, and so when they started their progress, we say that the car is in work in progress, and they termed those specific inventories as work in progress inventory or stock. And when they complete their work, when they have a finished product, they say it is a finished good, or they say it's a finished mobile, or they say this is a finished car, now we can sell them. When a product is ready for selling, we call them finished goods. These three types of products are different in different stages, and that's why we account them in different method. So what is finished goods? The manufactured items which are completed and ready for sale, we're calling them as finished goods. And we will learn in the senior classes that how raw materials, work in progress, finished goods are accounted for. When we learn cost accounting course, we'll learn those things, inshallah, in very detailed method. So if we conclude this section, we can say merchandising companies own the company and own the stocks they buy, and they are ready for sale. Immediately they can sell their products, and they only classify those stocks as inventories. But manufacturing companies classify their inventories in three stages: raw materials, work in progress, and finished goods. So now let's determine the inventories. How will we determine the inventories? In basically two different systems. Let's learn those systems. We have learned those things in our previous classes. One is perpetual system, and the other one is periodic accounting system. So the presentations and the mathematical methods are a bit different from each other. We'll be learning that, inshallah, in the next section. So here, let's learn about the perpetual accounting system. where accuracy of inventory records are checked in a regular basis. What is the physical count of the inventories are calculated in the perpetual system. Determining the amounts of inventory lost due to wasted raw material, shoplifting, or employee theft is a crucial point. Why? Because we can count those inventories physically which have been lost or shoplifted or theft. Moving on to the periodic system, the inventories are calculated or determined which is on hand. How many inventories are left after we sold a specific number of inventories. The cost of goods sold are determined also for the specific period, and the periodic system is a bit simpler than perpetual system. We just calculate the numbers and that's it. But in a perpetual system we have to keep a balance of every purchase or every sale. We have to keep records of the actual inventory units we have in our hand. Let's learn about a new topic, which is consigned goods. Consigned goods is basically a system of holding a number of goods in lieu of a certain percentage of commissions. If you can read the slide, it says, in some lines of business it is common to hold the goods of other parties and try to sell the goods for them for a fee, but without taking ownership of the goods. They are called consigned goods. If you can give an example from a practical perspective, we buy some things from dealers or brokers. For example, I have bought an IPS and its battery from a shop, but after 3 or 4 years the IPS is not working very well. It usually shuts down when the load shedding happens, but it shouldn't be. It should supply current when the load shedding happens. But I'm not satisfied with the service, so I called the shop that you should return my product and give me a new one, as it is under warranty of 5 years. But the shop didn't respond very well, so I have kept my IPS and its battery to one of my well-known service company of the IPS, and he told me that we will keep your IPS for a certain period of time, and we'll take a commission for that, and we'll sell that for you, and we'll give you the remaining money after deducting the service charge or commission. So I agreed with that, and they kept 5 or probably 10% of selling price as commission, and they gave me the remaining money. For example, we can give another practical example from a foreign perspective. A car dealer example of a car dealer can be effective here. If you have a used car to sell, a dealer may agree to put it on their lot and charge you a commission upon sale. It happens in the US and UK very often, very frequent, that you have a car and it's very old, you want to sell that car, but you're not getting proper buyer to sell your car. So now you want to get rid of your car, so a car dealer made you an offer that, sir, you can keep your car in our parking lot and we'll put a selling tag on that, but you have to give us a parking charge or a commission so that we can sell your car, and in return we will get a small percentage. However, the dealer won't take the ownership of the car. Your car is your car. You'll get the money, but you have to deal with the commission. You have to give the commission so that it remains in your possession, but the dealer takes charge of selling that. However, it is very important to note that even if you have the possession of your car, but you are not currently having that car in your parking lot or in your apartment or in your house, you are just keeping that in the dealer's parking lot. So it's not a part of their inventory, but it's yours as you have the possession. Even if you don't have the car in your parking lot, they're just keeping it to sell, and that's not their inventory, it's your inventory. You have to record inventory in your accounts for keeping that car in the dealer's parking lot. So that's an example of consigned goods. We are saying that, so to summarize, consigned goods are products or things or items that is in your possession, but you give that to someone to hold for you or to sell for you, and in return they will get some kind of service charge or commission for keeping your inventory. Even though that's not in your physical inventory, you have to record that as your inventory in your statements. Fine. Moving on to the inventory costing system. So basically we have talked about the perpetual and periodic system. Now we will talk about the actual costing methods of how can inventories be accounted for. The first one is the FIFO, first in and first out. Which products you buy first, you will sell those products first. For example, everything has an expiry date, right? If you stock soaps in your grocery store, there's an expiry date. For example, you are stocking Dove bathing soap in your grocery store, which have 1 year validity date. But you are saying, even though that Dove soap have 1 year expiry date, I wanna sell them first because I bought them first. I have to keep my stocks clean. That's how we say that's first in, first out. Which comes first goes first. We usually use this kind of accounting method for non-perishable goods, or it can also be used for perishable goods. If we buy tomatoes from large amount from wholesalers, we wanna sell those things first because those are perishable. They will perish at a very short period of time. So we buy when we buy first, we wanna sell them first as they're perishable. But in the LIFO method, last in first out, we usually do this kind of accounting for juices, for very low expiry date items. For example, if we sell yogurt have only 3 to 5 days maximum expiry date, so we wanna sell them first even if they come in last. And in the average costing method, it is weighted average unit. We just average them, make average rate, and we multiply them with the sales and to determine the cost of goods sold. So we will be doing a math today on the periodic cost, and we'll be concluding today's session after completing this math. So we were discussing about the math where a company ABC has a beginning inventory in January 1 of 4,000 units at 3 taka. Then the company purchased 6,000 units of inventories at 4 taka on January 5, and they have sold 7,000 of units at 12 taka on January 7. So now we have to determine the cost of goods sold of the 7,000 units in FIFO method, LIFO, and average costing. So first we are showing you the FIFO method. We have in January 1 we are taking the whole 4,000 units of beginning inventories at 3 taka, which will be amounted to 12,000, and then the remaining 3,000 will be taken from the January 5 rate, which is 4 taka, and we'll be multiplying that 3,000 units with 4, which will be amounted to again 12,000. So the total amount of cost of goods sold in FIFO method will be 24,000 taka. Now we will be moving on to LIFO method. Another thing, the name says first in, first out. So we are taking the first inventory which are entering the company, and then we'll be taking the next one. So we are moving from top to bottom, from first, then second, then third. So now let's see the LIFO method. Now we have solved the LIFO method, means last in, first out. We will be taking the last purchase or last item that have been taken into consideration. So among the 7,000 of units, we have taken the full from the January 5 purchase, which is 6,000 units at 4 taka. So we have taken that full, which amounted to 24,000, and finally the remaining 1,000 units will be taken from the beginning inventory, as we are considering the last in and first out. So it will be amounted to 3,000 taka, and by adding that we are getting 27,000 taka of amounted of goods, cost of goods sold. So there's a difference from FIFO and LIFO. FIFO is giving us a lower cost of goods sold than LIFO. So now we'll be going to solve the average method, and we'll be discussing that inshallah. And finally we will see a comparison between those three costing methods. Now we have completed our weighted average costing method. So if you can see, we have done a quite bit. In weighted average method, we have to calculate the total amount of units purchased and beginning inventory together. So we have to do that in 2 steps. In step 1, we have to multiply the units and its respective rates and add them together. What we have done here, we have multiplied 4,000 units of beginning inventory at its rate 3 and 6,000 with 4, and then we have added that and divided by the number of total units, which is 10,000. 4,000 plus 6,000 equals to 10,000. And after that we have calculated the number, which is 3.6. It is the unit rate, weighted average unit rate, and in step 2 we have to multiply that rate with the number of units of sales, which is 7,000, and we can derive from that 25,200 taka of cost of goods sold when we sell 7,000 units of products or inventories. Now we will be showing you a comparative analysis of the results and how they affect our costing method and accounting. Here is a comparative analysis of the cost of goods sold costing method we have done so far. So in the FIFO method we have derived on 24,000 of costs. In LIFO method we have got 27,000. In weighted average we have got 25,200 taka. So why is it different in different methods? Because we are doing in a different method. Each and every costing method is different, and thus the amounts are different from each other. So now what a company can do, they can select their own inventory method of costing their inventories, but they have to give proper justification of why they have used in FIFO method or LIFO method or weighted average. They have to disclose that in their notes of the financial statements at the very ending of the annual report, and they have to comply with the accounting standards regarding the inventory system. So we can see in the FIFO method it is the least among the three, which is 24,000. So cost, if you wanna show your profits more, or gross profit or operational profit more, then you can use FIFO method to lower the costs. But if you are doing a conservative accounting method, or you wanna do conservative accounting where you wanna restrict your profits, you can use the LIFO method, which is the highest among the three. But if you're liberal and if you wanna use the average rate, but it is not very much effective in most of the companies using a company-wide rate or a weighted average rate. We'll be learning traditional costing or traditional accounting and ABC accounting, where we learn about the plant-wide or site-wide overhead rates costing in the cost accounting course in the future. Now we are wrapping up this session by showing you the actual results if you have come in the actual conclusion from the slides. Here's the question once again. We were determining the cost of goods sold under a periodic inventory system. We were doing the inventory counting or determining the cost of goods sold in periodic system. We'll learn in our next class the perpetual system, which is a bit difficult, not difficult, it's a bit complex, where we have to keep a balance after every purchase or every sale. So moving on to the actual answers of the questions, how we can do in our exams. So let's see the solutions for ABC company, the accounting records. In FIFO method, we can do simply 4,000 into 3,000 plus 3,000 into 4,000, 3,000 into 4, which equals to 24,000. The LIFO, 27,000, and the weighted average will be step 1. We have found, or we determined the weighted average rate per unit, and then we multiplied the rate with this number of units sold, which is 7,000, and we get 25,200 taka. So this is the answer for the earlier exercise. In the next class, we will be doing this exercise on perpetual system, where we can see the beginning inventory. We are seeing 3 purchases and 1 sale of 550 units, and we can see a balance in units after each purchase or each sale. We'll be determining the cost of goods sold after in the method of FIFO, LIFO, and average. Weighted average, we can say also moving average. In the next class, we'll be discussing that, and also we'll be discussing the presentation of inventories, how we present them in the annual reports and financial statements, and where we put the notes, the justifications, what we used, the FIFO method or LIFO method or average weighted method. And we'll be having a mini quiz session, an interactive session on the basic concepts of the inventory recording method and its other theoretical parts, inshallah. Thank you for attending today's class. We'll be meeting on Saturday, inshallah.